Alright, what's going on, people? Back with another video today. On my personal account actually, but default chart settings so you guys will understand everything. But in today's video, I'll be teaching you guys what a fair value gap is and what a inverse fair value gap is. And so how in this video I'll essentially be showing you guys how you can trade off these key levels. They are similar to support and resistance, just used in a different way. Okay. Alright. What is a fair value gap? Yeah. What's a fair value gap? Yeah. A fair value gap is a 3-candle move. So, what I mean by this is, oh shit, I don't want to ruin this. No! Oh my god, oh my god, oh my god. Alright. What is a fair value gap? A fair value gap is a 3-candlestick move. Simple. So let me just draw you guys a 3-candlestick move. Boom, you got your candlestick. Boom. That's your first candlestick. Your second one. And your third one. Let's say third one is red. No, I'm in green. Okay. So essentially what a fair value gap is, I'm just thinking, no, it has to be green. Okay, doesn't really matter what kind of colored candlesticks are, but essentially what a fair value gap is it's a 3-candlestick move. So it's a 3-candlestick move. And so it is just imbalance in the markets. It's when the institutional traders, the quant traders or institutional banks, they've came into the markets with large orders. So what typically happens is that obviously you have a massive candlestick, which is right here. And so for the markets to fill in this imbalance, it needs to come back down and fill in this imbalance. Yeah, simple. Oh shit. Alright, so what would happen is, right here, this is a fair value gap. This is a fair value gap. And how it really works is, let me quickly explain. So it's a 3-candlestick move, yeah? Caused by majority of time banks or institutional traders with their large orders, causing massive imbalance in one candlestick. And so obviously whenever there's imbalance in the markets need to balance the markets. So what would happen is the markets would come back to fill in this imbalance. And so how it's valid and how it's invalid is, it's pretty simple. Fair value gaps are used by majority of the traders, and it's a good confirmation to trade off of. So here, these can be 2 examples. So this is your first one. This is your second one. And so, yeah, okay. Notice the difference here. What the difference is, the wicks. These are the wicks, obviously. And so what the difference is that with this candlestick, the reason why it's so big is candlestick is majority of it is the body, and then you have obviously the wicks, but How it's deemed to be valid or invalid is if the wicks are touching. So right here, this wick, the top of the wick is right here, and then so it's basically the first and the third candlestick. This is the first, that's the third. First, third. So look, 1, 2, 3, 1, 2, 3. This is the first candlestick, and this is the third. It's literally just the first and third. The top wick of the first and the bottom wick of the third. This right here is imbalance. Yeah, this is the top of the first, the bottom of the third. There is no gap, meaning that there's no imbalance in the markets. So yes, you can have large, big candlesticks, yeah. But what makes it an imbalance in the market is when the wicks are not crossing each other. So for example, if these wicks were like this, crossing, overlapping each other, so this goes below this wick and this goes above this one, then obviously this would not be a fair value gap. It's pretty simple. This is a bullish example, so let me quickly show you. Also I need to show you a bearish example before showing you how to actually trade off them. So bearish, if you guys still remember, bearish means down or selling. Bullish means buying or up. Other short terms for it can be long and shorts. So boom, this is a 3 candlestick move. This is a bearish one, a short one, a selling one right here. Nice candlesticks. This 3 candlestick move would obviously be valid because look, and obviously in a bearish move, first candlestick starts from the top and the third is the bottom. So look, 1, 2, 3, literally the opposite of bullish. The first and third candlestick wicks, the bottom of the first one and the top of the third one are not colliding into each other. So this is the top, this is the bottom of the first bottom wick, and then this is the top of the third wick. This is imbalance right here. This gap is imbalance, meaning that obviously this is a fair value gap. This is a valid fair value gap where the markets obviously need to reverse, or not reverse, but needs to retrace back into this fair value gap to fill it in because it's imbalance. It's imbalance. Let me show you a invalid fair value gap. An invalid fair value gap would be literally just, it's the same thing as a bullish example, just the other way around. So everything you're going to learn, all of these strategies, everything is the same, it's just the other way around obviously. So boom, obviously right here, this would be a valid fair value gap because there's imbalance right here. These two wicks are not colliding into each other. That's so meaning that that's valid. But for it to be invalid, you need this wick to be above. So boom, this wouldn't be considered as imbalance because the first candlestick with the bottom wick and the third candlestick with the top wick are colliding into each other. And so let me make a quick example. Sam, I hope you're taking notes. So boom, valid. Oh my god, my MacBook's screaming right now. Don't know why. Boom, valid. Invalid. Look, collides into each other. So pause the video and take these notes down. That's my valid. It's really simple and it is very useful to trade off. Most traders use it as a confirmation. I used to use it when I was a retail trader. So yeah, invalid, invalido. Yep, so boom, invalid. Yeah, make sure to pause the video and take this down. Quick slash break. Okay, Harry, I hope you're watching this video too, so you better take down notes. And yeah, look, valid, invalid, invalid, yeah? This whole example is a bullish example, and this example is a bearish example. So now I'm gonna delete everything. So now I'm gonna show you how to trade off fair value gaps. I'll use that box. But boom, let's go. So, depending on what kind of trader you are, I'm a scalper, so usually I use a lower time frame, like 15 minutes and lower. What you're essentially looking for is this. Let me look for a fair value gap. There's a bunch of fair value gaps, but also there's inverse fair value gaps. Let me go use the replay button. So actually, let me find a good example. Boom, this is a nice example, 30-minute time frame. What's this? A 3 candlestick move. 1, 2, 3. They don't necessarily have to be all green or all red. They just have to be it just has to be a 3 candlestick move. So this is the candlestick move. First candlestick and the third candlestick. What do you notice? This is the first of the top candlestick wick, and this is the third of the bottom candlestick wick. These two are not touching each other. They're not colliding into each other. So this becomes a fair value gap. And how you could have traded off it is, let me replay back into it. This is lower time frame, by the way. Wait for the markets to retrace back into the fair value gap. Nice. Boom. It's in a fair value gap. And then you literally just trade off this. So because this is a bullish example, you would... How do I make it? Because this is a bullish example, you'd be buying. So boom, you'd keep your stop loss below the fair value gap, which is around here, and aim for the previous highs, which is essentially around here. Not the best risk to reward ratio, but depends actually. Yeah, so look, you don't actually necessarily have to keep it so low, but let's say below this wick. Boom. This is a 1 to 2 risk to reward ratio trade. Enter for buys, enter for longs. Let's see what happens. Boom. Wait, boom. Khalas. Nice. Order filled. So this is a bullish example, but it's quite easy. It's a nice strategy to learn, but essentially what you're doing is you're trading off a retest. So whenever you see a fair value gap, you're waiting for the markets to retrace into the fair value gap. So this is the fair value gap. You wait for the markets to retrace into the fair value gap, and then you aim for the previous highs, which is right here. And when you enter for longs, which is you buy, and boom. Very simple, finito. Let's look for a bearish example. look for more examples. Boom. This could potentially be one right here. This is a form of imbalance in the market. I don't think the market's actually touched it properly. But yeah. Let's go down to the 5 minute. So let's say we're on a 30, or maybe 1 hour. Okay, nice. That's a lot nicer. So boom, this was a fair value gap. Let's wait for the markets to touch into it. 5 minute, 1 hour fair value gap. Yeah, what happens? Market retraces into the fair value gap. Nice. Boom, what could you use as extra confirmation? Boom, what happens here? Basic market structure. What's this? A chalk, change of character. So the markets do a reversal right here. And then you could have entered for longs, which is buy. Keep your stop loss below the previous low, which is right here. And aim for the previous highs, which is not really good, but you can look for the previous highs, which is around here. Around these highs. Let's see what happens. It should. Sam, you know you're messaging me right now whilst I make this video. Bruh. Okay, did the exact opposite. But essentially, boom, yeah, maybe I kept my stop loss a bit too tight because I was on the low time frame. But essentially what it is, yeah, is you're literally just looking for gaps in the market and you're taking trades off the retrace. So when the market retraces into a gap, which is right here, you enter for longs. But obviously, there's reasons on why I got stopped out, but I didn't obviously use my reasons or use my confirmations. But obviously, I'll teach you guys in the future videos. But yeah, so like this would be considered as a liquidity sweep and blah, blah, blah. But what you're basically doing is you're just trading off retraces in the market. So boom, fair value gap right here. This would be considered as a breakaway fair value gap because there's two imbalances here, or if you go into the 1 hour time frame, there's just one imbalance. But boom, and let's see what happens. Scale out to the previous highs. You don't really actually have to, but let's just say we target these previous highs. Would have gotten a better entry on a lower time frame. Okay, 1 to 2, and let's see what happens. Oops. Okay, consolidating a lot, which is not nice. Sorry. Oops. Literally edging our stop loss. It's not looking nice. Boom. Nice. But lots of consolidating, which is a bit weird. But obviously, oh yeah, literally stopped me out, liquidated me. But essentially, it's how it works. You're literally aiming, you're just looking for imbalance in the market and then aiming for the previous highs. Let me look for a bearish example. So let me find more bearish examples. I could find fair value gaps all day. Boom. Fair value gap, what happens? Imbalance in the markets push down, retraces back into this fair value gap, which is right here. Boom, pushes back down. Look for more fair value gaps. Just not that many. Breakaway fair value gap. Oops. I'm on too high of a time frame, which also also makes it harder to identify fair value gaps. But usually you'll be looking at fair value gaps on a 5 minute. So boom, fair value gap right here, fair value gap. Let's see what we've seen in 15. Okay, 5 minute. Okay, let's go. Look for, yeah, we're here. Fair value gap right here. It's just imbalance in the markets. Fair value gap right here, which 5 minute one, which market taps into. Let's look for more. Bullish fair value gap right here, but obviously this is going against the trend. Yeah, no, you can't really consider it because it made no move. Let's look for bullish examples. Fair value gap right here. Fair value gap right here. Fair value gap right here. These are fair value gaps. That's how you trade off them. I think the video is a bit too long, but next video I'll explain on how you can trade off inverse fair value gaps. And so the reason why you may potentially be seeing, obviously you're not going to trade on the 1 hour time frame because these are, you can consider them as fair value gaps if markets break through. So that's an inverse fair value gap, but you're not gonna, I'll explain in the next video. It's a lot more complicated. Usually you're gonna be trading on the 5 minute time frame or lower than the 30-minute time frame. But yeah, I'll explain what these large moves mean and how you can capitalize off them. So, goodbye. Goodbye, goodbye.